Hi, good afternoon, everyone. We might make a start. Good to see many of you. My name, for those of you who I have not perhaps met yet, is Dr. Beverly Loke. I'm a senior lecturer in the Department of International Relations at the Corabell School of Asia Pacific Affairs within the College of Asia Pacific. I'd like to start by acknowledging and celebrating the first Australians on whose traditional unceded lands that we meet on today, that we learn on, that we gather on, that we work on, the Ngunnawal and Ngambri people, and to pay my respects to elders past, present, and emerging. I should also say that I'm the co-convener of the ANU China and the World seminar series, along with Dr. Xian Wang, who's the other co-convener. So welcome back to the start of a new semester. We're in O week, so it's a little bit quieter. But hopefully we'll get back to it from next week onwards. And we also have a great lineup of talks scheduled for you this coming semester. The first of which, with great pleasure to announce today, the ANU China Seminar Series, along with the Crawford School of Public Policy's China Economy Program. We have the talk today by Dr. Sherry Tao Kong. Great to see you here. Entitled Bridging the Gaps, China's SMEs and the Promise of Inclusive Digital Finance. So let me just briefly introduce our speaker today, and then a little bit of housekeeping on the format. So Dr. Sherry Tao Kong is an associate research professor, is head of research at Peking University's Institute of Social Science Survey, and is also a senior research fellow at PKU Institute of Digital Finance. She also teaches quantitative analysis for area studies at the PKU University of Area Studies. Prior to joining Peking University in 2012, Dr. Kong was a research fellow here at the ANU from 2006 to 2012, conducting research on labor migration and its impacts in China and Indonesia. And before that, she served as an economic consultant to the World Bank from 2005 to 2007. The current research focuses on income distribution, China's middle income group, micro, small, and medium-sized enterprises, and the digital economy in China and Southeast Asia. So very warm welcome. Very much looking forward to your talk. Just before I hand over to Dr. Kong, just a couple of announcements on the format. So Dr. Kong will speak for about 45 to 55 minutes. And then we'll have Q&A. We are also on Zoom. So as the moderator, I will be collecting a round of questions from the audience here, but also moderating the chat on Zoom. So for those of you who are joining us online, please do send your questions via chat and I'll read them out during the Q&A. So without further ado, thank you.
Thank you. Thank you very much, Beverly. Thank you so much for a kind introduction. And my sincere thanks to every one of you. I understand I should definitely not take it for granted in the coldest month of Canberra and in a way during the break that you made all this effort to be here. I really appreciate it. Thank you so much. And today I have around 45 minutes to share with you this topic on China's small and micro enterprises, as well as some development on the front of inclusive digital finance. Let me quickly tell you why I want to work on this topic. So the first thing is, so why SME? For many of you, you probably are familiar with the vital role of SME in China. Like in most developing economies, SMEs constitute a huge chunk of employment in the labor market. And in China, it constitutes more than 80% of the urban employment. But in addition to that, it also contributes to more than 70% of the innovation, 60% of the GDP, 50% of the tax revenue, as well as it accounts for more than 90, in fact, more than 95, by some accounts will be 98% of all the enterprises registered with the authority. And with our research looking at this sector, we actually know many of the business people, also in terms of small and micro business merchants, they are operating without any registration. So in terms of the total size of this sector, we're talking about around 300 million people. That's how big it is. So I guess with that, I hope I can convince you it is a very big, very vital, and very important sector for Chinese economy. And with that, you understand that with the employment, with income and consumption, it is also playing a very important role for China's switching from an investment-led growth model to a more consumption-led and innovation-driven kind of a growth model. So very much this sector needs to be looked into and how they fare and how they can play a very positive and competitive role in the economy, also the key for China's development path as well as its social stability. And also put it is a barometer of the social economic confidence. Many were saying, especially in the post-COVID period of time, confidence is even more valuable than gold, meaning if people have the positive and optimistic outlook, they will go out and expand their business, and they will create jobs, and they will basically put new engine and new impetus to the economy. But again, whether this crowd is having that very positive, optimistic outlook is a question, and I will show you more about our evidence based on the long-term survey. Okay, and before I go into the details, let me share with you a couple of key observations. So in this talk, we are going to talk about SMEs facing persistent headwinds. So we have data starting from the third quarter of 2020 all the way till now. As we are talking, we are looking at the second quarter of 2025 as to how they are doing. And here I summarize the top three source of stress. One that has never changed is always a sluggish market demand. Second is operational costs. So they've been always complaining and worried about the cost. And third, stressor has been shifting from policy uncertainty during the COVID time to debt repayment burdens during the post-COVID period time. And this is what we are facing. These are the issues and problems that SMEs are struggling for all this period of time, and pretty stable observation. And taking that as a factor, how would the development of inclusive digital finance to some extent it can help, can address, can provide some opportunities, some potential engine to address the issues and problems confronting SMEs in China. And the reason we are looking at the development of inclusive digital finance is because China is very much at the forefront of the global development of fintech or digital finance. In other words, for many of you have traveled to China over the recent couple of years, and you realize we are also cashless. I realize this time in Canberra, we're also cashless over here, but people use cards to tap. In China, when we say cashless, that means we only have this. We only have mobile payment. We don't have a wallet. We don't have cards. We don't have nothing. So basically, wherever you go, you order everything, you pay everything with your mobile phone. So it's mobile payment. It's very much the infrastructure, if you like, the infrastructure of digital financial services. And so with that, a lot of financial services which used to be provided by the conventional financial institutions and now are provided all online on the platforms by the digital financial companies. And so with that, would that give micro and small business people who have long struggled with financing, with getting access to loans, having a new way to be able to get access to credit? So this is the setup we want to talk about. Would this be the promise? Can this promise be delivered? And I want to give you an overall description of what's the reality. Now, despite of the encompassing or ubiquitous kind of coverage of digital payment, the use of growth critical financial services provided online is still quite limited. And putting this micro level observation into a bigger macro level context, we are observing in this, especially over the past 1.5 years, when the central government is trying to push the state-owned banks, the big four, to lend to small and micro business in order to give them more impetus to grow, in order to stimulate the economy. We are saying we are observing the piling up of SME lending, and the outstanding debt lending to SME now accounts for more than 60% of the GDP. Is that really a healthy thing, given that most of the big banks, yes, they have a much cheaper, cost-effective capital, but they have less ways and less technology in terms of monitoring SMEs, which are notoriously uncertain and they don't have collateral. So by giving so much lending to SMEs, you really build up some systematic risk in the financial system, and that's not really the good news. So to this point, can digital financial services, where everything's built on the platform, where you can monitor the small and micro businesses, how their transactions are being handled, how their operation is being handled, you have much better ways to monitor them, so that you have a much more effective cost management, basically, mechanisms. You can keep the non-performing loans at bay, yeah? So would that be another reason to say, can we tap into this largely untapped potential to unleash the power of inclusive digital finance, so that they can help SMEs do a better job while keeping the overall balance, the balance in terms of risk management and providing loans to small and micro businesses in a healthy manner. Yeah. So this is basically the main theme of my talk. For in the rest of when we have time, we will go through the evidence and details. Yeah. There we go. The central question I've pretty much covered. Yeah. Okay. So these are the 4 parts, which I think it's a bit ambitious to go through all of them, but if we don't have all the time to go through the detail, I will show you lots of empirical evidence, to show you a lot of graphs and what we have observed over the past few years. I'm really happy to come back to this during our Q&A session, but you got the gist of the story. Okay. So with a macroeconomic background, I will put it very simply, and I think many of you are familiar with the general context. We have heightened external risks as we are speaking. The negotiations, the bargaining, the games are being unfolded. And the second thing in China, which has been really big, is the significant property sector adjustment. I will show you a little bit how it has worked out over time. And then aggregate demand has been weak, has been sluggish, and that's always on the cards, and a lot of pressure. The government has rolled out many policies in order to stimulate consumption, and small and micro enterprises closure in terms of the banking sector or the lending to SMEs is increasing, and we are observing forbearance scheme being extended. Yeah. Okay, so this is a graph which just came out from a paper with our colleagues, Yiping Huang and others for NUS, which nicely summarizes the couple of main macroeconomic indicators, where you can look at the growth momentum. We kept it into 2024. We kept the 5% target, yeah, with a lot of effort from various sections of the economy. And this year, in the first 2 quarters, we are set on a pretty sustained momentum. So it's I think the growth target are being met. But what we can also observe is that the retail growth, retail growth is still very moderate, and investment growth is also kept at level. So the general indicators are pretty positive, but I think that there's still a lot of reasons for concerns, therefore, knowing that it is still, we're going through a trying period. And for the property market, this is over the years, and we can tell, especially in the first tier and second tier cities, we're still struggling. There's some signs of a stabilization, but the general sentiment is still pretty low. Yeah, the prices are not growing. And this is this third graph is particularly relevant to today's talk, is to look at the banking sector, how the credit allocation for SME lending now is in nearly 90 trillion. So we're talking about out of 130 trillion, this is a huge chunk. And the quality of this credit is questionable, even though the discussion about failed or non-performing or default on this front is limited, but there are some smaller banks that have already disclosed up to nearly 30% of bad loans. So given the size of this exposure, it is certainly worth looking into it and thinking about whether we should worry about a systematic risk. Yeah. Okay, now let's focus on the main story of today's talk, is to look at how SMEs are doing. And I want to introduce to you this survey work we have been doing since the second quarter of 2022. By now it's 5 years already. 20 quarters worth of data, around 200,000 observations we'll be looking at. And with that data, I can give you a pretty clear portrait of what SMEs are like in China. Who are they? What kind of characteristics they have, and how they fare. Yeah. Okay. So this is a survey called an Online Survey of Micro and Small Enterprises, a short name OSOME. We have a questionnaire put online. We work together with the Ant Finance, which is Alipay, as you're familiar with, and we put on Alipay as well as the online bank WeBank, MyBank, and we spread the questionnaire. And every quarter we have around 6,000 to 8,000 response being collected every quarter within a period of 1 week to 10 days, and we get all this information. And with this survey, we have quite a bit of characteristics of the businesses as well as the merchant themselves, and we ask them about how they fare, what kind of revenue they have achieved in the past quarter, as well as the sources of stress and how, to what extent they digitalize. And on the financing side, we also ask them about their confidence level. Yeah. And so over the past 5 years, we've collected a lot of data, and this is a joint work with my colleagues at Peking University as well as and research. Yeah. So here's just a couple of slides about what they are like. Whom are we talking about? What kind of people are we looking at? What kind of businesses are we looking at? In terms of employment and what kind of the size of their staff, many of them are self-employed, and most of them, absolute majority of them have they're really small and micro. So the number of employees are less than 20. And on average, this is very much taking into account a small share of the SMEs that do employ maybe 10 or more than 8 people, but most of them, more than 80% of them, have a 0 to 4 employees. When we say 0, that means that they don't hire anyone outside themselves, yeah. And in terms of regional distribution and demographics, they are very much clustered in the eastern and central regions. No surprise in Guangdong and Henan, you have the most of them. And the age group, SMEs fall into mainly 80% of them were born in the 80s or 90s. So you know the age group is under 40, basically around 40 or under 40. And they are surprisingly, to some of you, this may be quite reasonable, but at the beginning, we were surprised that 80% of them have higher high school education. In fact, many of them are college graduates, even postgraduates. And this actually set the basic foundation for them to digitalize, to take advantage of the digital financing and all other things. And so their literacy level is already way up there. So they are geared towards acquiring more skills and moving along with the technological progress. And in terms of sectoral distribution, they are predominantly in service and especially in household-related services, not in business service. Yeah, so they are the ones who are providing with retail, wholesale, catering, beverage, all these other services. So they are very much next to you. Yeah, and in terms of how they do their business, many of them, especially after COVID, many of them are doing offline only, and some of them, so 1/3 are doing both online and offline. And this, yeah, so offline is still their predominant way of mode of operation. And when we're talking about the small and micro, this is not just manifested in terms of how many people they hire. This is also shown in terms of how much money they make in terms of their revenue. So nearly half of them barely make it the cut. Yeah, so they only make 25,000 per quarter, which means around 8K per month, and that's not much at all that month. So we call them subsistence. We call them in China, we call them a 糊口型. They just made it, yeah. But of course, whether this is their only source of income, no, not necessarily true, but to some it is. But this, when we say they are small and micro, they are truly in the sense of being small and very, very vulnerable because of that size. And not everyone is making money. 20% are not making any profit, and nearly a quarter just break even. Yeah, and offline, as we said, and this is the summary stats from the first quarter of this year. So this is pretty much the reality we have been observing over the past 4 years. Yeah. And here are a couple of slides to share with you the main findings and what kind of situation they are in. Their revenue hovering around, this is hovering around, still fluctuates, but most of them will have a slight increase after the COVID time, but it's all at a pretty low level. And the middle section here shows the number of months their cash flow can last them. So on average it's around 3 months, yeah, but many of them would have cash that will not last them. So we have categories below 1 month and up to 3 months or even longer. So many of them do have cash flow constraint, and the average size is less than 4, around 4. Yeah. And with that macroeconomic stress in terms of weak demand and the rising costs, the confidence level of micro and small businesses in China are always hovering around the critical threshold. So basically, above 50% will be counted as being optimistic, below will be pessimistic. So at best, they are somewhere just trying to figure out. So it's like a half. So many of them are not very optimistic. We hope we could present you with some more promising pictures, but very much in terms of the overall sentiment, it is quite worrying, quite down, yeah. And especially with the cost, yes, it's getting less negative, but it still remains in the negative zone, yeah. And in the last one is in terms of the size of employment. So basically, whether you are thinking about expanding, creating more jobs, it's also not very optimistic, which means that they are very reluctant to expand, create more jobs, and that's not very good news for the employment situation. And in terms of what they are feeling most challenging, sorry. Here's so this is in terms of percentage of SMEs saying, oh, this is really an important, our major source of stress. This is in terms of cost, and this is in terms of market demand. So it's always been the top challenge. And during the period of post-COVID, this debt repayment burden becomes the number 3 source of stress. Before that, it was the uncertainty with COVID pandemic policies. Yeah. And as the government has rolled out many policies in order to release the stress, the coverage of policies that have really benefited any of the small and micro businesses is substantial, but still, but it's generally below 50%. And this is partly because many of the policies are targeting taxpayers, targeting those businesses that are contributing substantially to social security funds. But many of these small businesses simply don't pay tax. They don't even pay for they don't contribute to the social security fund. So the compatibility between policies and the nature of these businesses are sometimes not matching. Yeah. And financing is another thing. Government has put a lot of effort in promoting financing for small and micro businesses. For a long time, the main job were left with smaller banks and online platforms. But what we observe, which I will show you later on, is the big banks are coming in. Digitalization has always been pretty high, especially in terms of the use of electronic information system that has exceeded 70%. But online operation as well as a multi-platform operation has constituted around 30 to 20% for the multiple online operation. Yeah. So this one is very busy, which I only highlighted these 2 lines, which just want to show you as a main source of finance. So where do these SMEs get credit when they don't have collateral? They have very little track record in order to apply for loans from the big banks, and their businesses are hard to be monitored. They are subject to their unique vulnerability. How do they get loans? So for the first few 3.5 years, what we observe is the top one source of loans is from the online borrowing of digital financial institutions. So because they can't get lending from the traditional banks, they get from online platforms. So that's the most sort of intuitive. These online platforms provide this instant service, less requirement in terms of the track record, and no collateral required, because they've got the data, they've got the information as to how this business operate on this platform. So they know their transaction, they know their revenue, they know how they have been doing what they are doing, what they say they're doing in terms of business. Yeah. So this has been the case, and up until the first quarter of 2024, we see the top supplier of business loans has changed to traditional banks, especially the big four. And we asked the banks, what's happening? They say, oh, the KPI, KPI worked in the magic. And now the big four have KPIs in order to fulfill, how much lending they have provided to SMEs, in concrete terms. So this has been the case since the beginning of 2024, and I think that provides a micro level evidence to show you why there's a piling up, why there's a building up of SME lending in our system. Now, linking this with inclusive digital finance development in China, this is just a very quick timeline looking at how barely 20 years ago, Alipay was launched by Alibaba Group, was mainly to provide a third-party payment system for the e-commerce marketplace called Taobao in China. And 2011, so only less than 15 years ago, Weixin was launched, but now in China, everybody is on Weixin. We work on Weixin, everything is operated on Weixin. And this has become the other dominant and biggest social media. And the reason this social media is important is because later on it also had WeChat Pay as opposed to Alipay. These two are the top and very much the dominant third-party payment platforms or apps. And together, so basically anyone who's using mobile payment is either on Alipay or on WeChat Pay, most likely on both. So if you look at the infrastructure of digital financial services in China, which is payment, you basically just look at these two. And there are quite a few others, but these two are the default setting. And Yuebao, which is basically cash fund management app, is established by Alipay, also marks a milestone in China's inclusive digital finance development, because this is the very first time, the money market fund of investment now is made available for everyone. In the past, if you want to make an investment, you need to have quite a handsome amount of funds put aside, and you go into the big banks and talk to the fund managers, you talk to the investment manager, but that's pretty much inaccessible and exclusive for most of the population. But here with Yuebao, basically starting from 1 yuan, you can do these things. So that is the inclusive part of the, or to some extent, the revolutionary part. And from there, many other financial services in terms of investment, in terms of buying insurance, in terms of installment and other sort of services are all made available to the general public. And for this part, I'm going to use the China Family Panel Studies, which is also operated at Peking University at the institute I'm affiliated with. This is for many of you, you're familiar with this data source. It is pretty much the only longitudinal household level survey that is still running in China. And it has a nationally representative sample spanning from 2010 all the way to 2024. The most recent data released in 2022, and in that survey, me and my colleagues proposed a special module on the information of digital payment use by the Chinese population. So this is very much for the first time. I mean, for the first time with nationally representative data, we can see how Chinese household, Chinese population are really making use of digital financial services. In the past, we heard a lot from the service provider, from Alipay, from Tencent. They say, oh, we've got 1 billion users, we've got 800 million users. But for them, of course, they don't know who the non-users are. They don't understand the device. They don't understand why those who are not making use of the service are not making use of them. Yeah, so here we can understand the characteristics behind the users and non-users and ask the question, is there a divide and what's behind this story? Yeah, and so I just show you a couple of slides in terms of coverage firstly. So overall, less than 80%, so around 3/4, if you like, 3/4 of the population are making use of a mobile payment. So that doesn't sound like a universal, that doesn't sound like oh, everybody is on board. So this is at the individual level, and we also stress that there is a variation across the different groups in terms of, say, urban versus rural, different education, different age group, and different income group. So as you would expect, urban will have a higher level of users. So the dark bars indicate the household level, the blue bars indicate the individual level. And when we say household, that means that if you are living in a household where at least one person is making use of mobile payment, then the household in general have access. Yeah. So we want to look at both, and this is quite important to differentiate individual level and household level, because when we are zooming in to look at the household level, especially for a lot of elderly who are relying on their children to make use of digital financial services, the household level coverage is around 85%. And given the age differences, so basically below 40 is 99%. So given time, this divide will disappear. So basically everybody will on board. So my tentative kind of assessment about the inclusiveness part of the story is that it's done, the coverage is done. So you don't really need to worry about people are being excluded in terms of a digital financial, basic digital financial services. But of course, in the meantime, there are still people who refuse to use it or who cannot use this, and then you need to give them the option of paying cash, paying by cash and other things, but provide them with some support. But in general, given time, you don't have to worry about the coverage story. But to what extent they are actually making use of the service is the question. It's like you build the road so people can walk on the road. They don't have to walk in mud. Yeah, here are the roads, but are they really making the road a productive source of resource allocation and for productive purposes? Are they running business? Are they going to get themselves better skills? Are they really investing, taking advantage of the availability of this road, meaning the digital financial services? Not quite. So in terms of intensity, if we say you need to, if you make use of the mobile payment at least once a day in terms of your frequency of making use of it, it still remain quite low. So only 40% of them will use it once a day. I'm sure our students here probably use it 7 times a day or 10 times a day, the high frequency users. But many don't, even though they can use this, but they don't use it that much. And what matters even more is to look at the depth. So with all these services, in addition to payment, you can invest, you can borrow, you can apply for installment, you can buy insurance, you can use the credit rating. So basically you can make digital financial services work for you in order to serve the purpose of, capital as a blood for the economy, so that the blood circulation can flow more effectively, so you can bring better drive to the economy. That is not quite happening. Even amongst the users, for those who are using mobile payment services, only 14% of them, based on the household survey, only 14% of them are using any of the services in addition to payment. So basically the depth is very shallow. So people use it to pay, they scan the QR code, they pay, and that's it. They don't even put the money set aside in the cash fund, which is basically risk-free. Yeah, that will give you more return than putting in the streamline account, in the saving account. But no, people are not doing that. not to mention about buying shares, doing investment, and doing other things, installment to smooth your consumption and do many other things. So they are not really doing it. Yeah, so that's a funny thing. So we want to unpack, so what's happening? Why everyone seems to be on board, but they're not really taking advantage of the availability of digital financial services. So here we first sort of try to, this is ongoing work, this is still quite preliminary. We looked into, so what are the, in what kind of situation do people actually are interested in making investment, and why do they need to do an installment, or why do they need to borrow? So does it have something to do with their household income, their saving, their propensity? Maybe it's just a preference. They don't want to borrow. They don't want to owe other people money. So they don't want to borrow anyway. It's not just about platform. It's just they don't want to owe anyone. They don't want to be in debt. Or for those who are self-employed, especially business owners, you will imagine they have higher demand for loans, for lending, for financial services. So is that the case? And we can see some sort of some basic correlation. So for example, this is investment. Yes, household income matters, and how much they save matters. And if you have a large sum of saving, of course, you will have demand for investment. So that's all quite intuitive. Yeah. But whether you are happy to borrow from other people doesn't affect much in terms of your investment choices, decisions. Yeah. So we also look at this is insurance, and this is installment and lending. Yeah. So all this quite clearly shown, if you are self-employed or you are a business owner, you will have greater demand for lending. And in addition to that, there's also questions we ask. We say, well, maybe people just don't feel comfortable with borrowing online. That's why they don't want to make use of this digital financial services. And in terms of whether they feel internet is quite important, that's like a affinity to internet services, and never borrow a loan. So basically, someone is very have this aversion towards being in debt. Yeah, so then they don't want to make use of the services. But what is for the pretty much, I think, as to the best of our knowledge, first being asked at this time is something. Right, just. I don't have to, yeah, okay. So this is these two questions, and this is information safety and fund safety. So this two elements we put together, and we call it a fintech trust. So basically, people may not feel it's very safe, either because they leave money on the platform. They are not your traditional banks you walk in, you know, they are somewhat affiliated with the state, they have a physical establishment. This is all online, all in the virtual world. It's just a number shown on the phone. What if something goes wrong? So they feel there's a security issue with the fund, a safety issue with the fund, and on the other hand, it's also information or privacy issue. So do they have trust with this online services, with this digital financial services? So that's for the first time we call it a fintech trust. To what extent they have trust in the service provision. And the last bit we also ask to operate on your phone to make decisions, investment decisions. Is not an easy matter. To many people will feel, no, I don't know what's doing. I'd rather talk to an advisor and do that. So it's more like a financial literacy issue. So all the things you do to some extent explain the use or not to use financial services online. We have a separate paper looking at the fintech trust issue, because people have been talking about Chinese don't care about their information, their privacy. Yeah, we are already so transparent, cameras everywhere, so we get our data collected wherever we go. Everything we have to register with our real name, with our social security card. So someone there is out there knows so much more about ourselves, so we don't care about the information privacy issue, but is that true? With our data, we can do some exploration. The preliminary result, if you're interested, is that in fact it is to some extent there's a paradox. So we say we do care, but when it really comes to behavior in terms of giving information, doing things, this information trust in terms of information security does not explain anything. So basically, it seems like we are not making decision based on the extent we care about our privacy. But fund safety matters because it's a real money on the platform. You're making investment. If you click the wrong button, you make the wrong decision, yes, there will be real consequences. So the repercussion is there. So this is one of the project we are still looking at, but that is quite interesting. And okay, so in terms of so if now we link these two things together, we want to provide financing for SMEs. So because they are struggling, they are facing limited access, they're facing high cost of the credit, and we need to finance them. They are important, they are a vital drive of the economy, but at the same time, we need to manage the systematic risk. So can we find a way to balance the state bank lending, which is being pushed by the policy, not so much market driven. It's not determined by the market, it's very much policy driven. And in the meantime, we, to some extent, enhance the utilization of digital financial services. Yeah, and to some extent, maybe fintech trust can provide some answer to that. So just putting the observations together, financing for SMEs has moved from borrowing from digital financial institutions on the platform to the big state banks, and that builds up the outstanding loans exceeding 60% of GDP, which is a really an important source of worrying. We should be looking at this. So to what extent these loans are healthy is a big question mark. And in fact, many will argue it is not sustainable. It's the quality of the loan is very limited, it's quite low. And if there's a large scale of default, then it will certainly put a dent to our economy and introduce a systematic risk. And then on the other hand, the availability of digital financial services where you have much better risk management, you have AI, you have big data to help in managing and identify different kind of business, what kind of how well they are performing, whereby you have means and tools, effective tools to finance them with better risks, yeah, with risk management. But this is very much underused. So given this situation, can we find ways to promote? So my question is, can we find ways to promote the better use of digital financial services to provide credit, much needed credit to SMEs in a healthier and more sustainable way without introducing huge systematic risk? And one way to improve that is probably this fintech trust, or what we call, to look at how the Chinese household or individuals are looking at this issue. So we have here what we are looking at is characteristics of individuals interacting with this two type of trust in financial services, digital financial service use. The top one is fund safety. So basically the vertical lines are indicating to what extent you think your fund is safe on the digital financial platforms. And these are the gender contrast, yeah. So obviously guys are a lot more confident and thinking this is quite trustworthy. And this in terms of age, younger people have much higher or greater level of trust in terms of digital financial services and those who are employed, and there's those who are, and to some extent, surprisingly, it's the rural people who think it's more reliable. Their fund on the platform is quite safe. And here is for the privacy or information safety. Again, you will see some correlation. These two, in terms of gender and age group, is pretty much consistent. But in terms of employment and rural-urban divided, this is there's a different picture. Yeah, we can observe. And why trust is important is because partly we can look at how to what extent, financial advanced, we call advanced financial services is like investment, loan, installment, insurance are being used when the trusted level is high. And there's a clear correlation between fund safety, trust in fund safety, and the use of different types of financial services. But again, in terms of information safety, it seems it really didn't come up with a clear pattern. So maybe to an extent, yes, Chinese are not so worried. They are worried about when it comes to decision making, whether they want to make use of digital financial services, that doesn't play a major role. So how we can build the trust and how we can make the information more accessible, and in the meantime also increase the digital financial literacy of the general household, which covers a large number of SMEs, is probably one of the areas that the policy makers can also look at. So that's basically the general story I would like to share with you. This is an ongoing work, so please do give us feedbacks and suggestions and comments, and I thank you very much for listening.